Greetings, everyone. This is Richard Crevo bringing you today's trading concept, and it is identifying a change in trend. And our requisite risk disclaimers here. Trading foreign exchange involves a significant level of risk, may not be suitable for all investors. You should only be trading with risk capital. Do not invest money that you are not in a position to lose. The high degree of leverage can work against you as well as for you, and the content provided here is for informational and educational purposes only and is not intended as a specific trading recommendation. Okay, let's take a quick look at our chart here that I'm going to be using. Just center everything up here a little bit. And let's see. Okay. Now, one of the questions that I most often get asked is how a trader knows when the trend has changed or when the trend is changing. Now, while it is definitely an important question, the answer is also one of the most elusive, if you will. The answer is definitely not an absolute answer that is totally black or white and cast in stone for all time. Like I said, it is on the elusive side. So let's take a look at this historical daily chart of the Aussie USD currency pair below. And you can see down here in green, just in case you're not able to read it, it says pair is in an uptrend as pair builds higher highs and higher lows and breaks above the 200 period simple moving average, which is the green line. And then the pair is in a downtrend as it builds lower highs and lower lows and breaks below the 200 SMA. The green lines here are the higher highs and the red lines are the higher lows as it moves up, and so forth. So this last candle on the left of the chart is dated December 15th, 2011. I said it was a historical chart, and these principles are timeless as far as chart reading goes, so don't worry about that. So that last candle on the left, this is when the current uptrend began, right over here. And we can see on the chart that the uptrend consisted of price making higher highs and higher lows, breaking through significant resistance levels, and those presented as well by the resistance level presented by the 200 period moving average. It broke above that as well. And also at the time of this particular analysis, the Aussie dollar was one of the strongest currencies and the US dollar was one of the weakest. And if you want to learn more about strong currencies versus weak currencies, email me at rcrivofx, rkrivofx @gmail.com and ask for the strong weak analysis, and I'll explain to you how we can go about doing that, how I go about doing that each day. So when all is said and done regarding the uptrend, price reached its highest point right up here in this area on February 29th, 2012. And this move to the upside lasted around 2.5 months and was comprised of about 1,000 pips. Okay? And then we see the pair traded in a range. And oftentimes, when this uptrend comes to a stop, price action will trade in a range or consolidate for a period of time. And in effect, this uptrend stalls, and the pair just bides its time until the market decides how it will continue to trade the pair. And we can see this in that yellow triangle in the upper left-hand side of the chart, right in here where my cursor was. Now, in hindsight, we can see that when the pair broke out of that rectangle to the downside for the first time, that was the official beginning of the downtrend, like I said, in hindsight. However, since none of us has that infallible crystal ball, no one knew that this was the end of the uptrend and the beginning of the downtrend at the time. So you're going to wait for more and more confirmation because, again, nobody has that crystal ball that they can tell, uh-oh, this is going to continue for a long time moving down. Possibly, but nobody knew for sure. So as traders, what do we need to see that indicates a growing potential that a trend change is happening and that it's likely to continue? Because that's what we're interested in seeing. So let's reverse engineer what we saw happening in the uptrend. If we look for the opposite of what's going on in an uptrend, we should be looking at a downtrend. So if higher highs and higher lows make an uptrend, then lower highs and lower lows will make a downtrend. And in looking at the right-hand side of the chart, over in this area here, we can see that this, in fact, is taking place. The more this process of higher highs and higher lows continues, the greater the likelihood becomes that the downtrend will continue. So at this point, okay, it broke out of the range to the downside. That's a good sign for shorting the pair at that point. But as each lower high and lower low continues, that's more and more and more confirmation that the pair is moving to the downside. So a lot of traders will try to get in at the very first pip of a move. More power to you. It's tough to do. I suppose it can be done in certain remote situations or certain isolated instances, but it's much more difficult to do and get in right at the beginning and then naturally stay into the last pip of the move to the downside. Virtually impossible. What you want to do is wait for a certain amount of confirmation to take place, and then if you can just get in at the fat part, if you will, of the middle of this particular move, right in here, you don't have to catch the very first move to the downside, nor do you have to hang around for the last pip. You can make a substantial living and profit off getting into a trend after it's confirmed and getting out at a certain point of profitability before it begins to potentially go in the opposite directions. Now, we also note that as this particular pair moved to the downside and that continues, the Aussie dollar became weaker and weaker and the US dollar became stronger and stronger. So in that strong weak analysis, what we saw over here, we're going to see the opposite over here as the currencies individually start to strengthen and weaken, if you will, in the opposite direction. Now, at no point in this process is a trend change guaranteed. The more the move continues, however, the greater the chance becomes that the trend change will in fact become a reality. But as we all know, I mean, trading is and currency pairs moving definitely a work in progress, and it changes from, depending, sometimes from day to day, sometimes from hour to hour. So what I'd like to do is mention 3 areas that I monitor when considering whether or not a trend change has in fact taken place or is taking place. First one, if the pair continues to make lower highs and lower lows and take out levels of prior support, prior resistance, that type of thing as it moves down, the pair is building a downtrend. The longer that process continues, the more it is likely that there will be a trend change. Okay, the question begs asking, how long is longer? Again, no black and white answer. Aggressive traders will call the trend change earlier and start taking short positions sooner than will a conservative trader. Number 2, as price action begins to move closer and closer to the 200-period simple moving average, the closer it gets to it, the more likely that we are looking at a potential trend change. Once price action trades through the 200-period simple moving average and closes below it, that's a very compelling piece of data that the trend, in fact, has changed. Number 3, if the currency in the pair that has been the stronger currency has become the weaker currency in that pair, and that change continues over time, that again is pointing to the probability that we're looking at a trend change. So in the end, while there's not much certainty in calling a trend change in the short term, the above 3 points are what I monitor to determine if a trend is continuing or losing momentum and ultimately changing in that direction. If you have any questions on this, again, feel free to email me at rcrivofx@gmail.com. Thanks for listening. Bye now.